Good evening. This is the Eye of the Storm podcast for Saturday, December the 10th, and I will be discussing the S&P 500, the NASDAQ 100, the 30-year bond, the 10-year note, the 5-year note, the 2-year note, gold, silver, and the US dollar. So, welcome. And let's begin here. I'm going to be updating the large picture, the bigger pictures, and also including what we can be expecting next week, because of course we know that December the 14th, which is Wednesday, we have the Fed decision for the latest hike. Going into this week and going into that meeting, the accepted market position on all of that has been that they will slow the speed and raise the rate 50 basis points instead of 75. Also, next week, we have the CPI on Tuesday. That could change the whole picture going into Wednesday. And I have to trust that the Fed already has this information. So when they go into their meeting on Tuesday, where it begins, and then on Wednesday, that they will have all of that information, and their decision will be based accordingly. So we have on Tuesday, the 13th, we have the consumer price index, and we have core CPI. Those all come out at 8:30 Eastern time. So all the different components of a consumer price index. On Wednesday, of course, we have the Fed meeting itself. On Thursday, we have initial jobless claims, retail sales, the Philly Fed manufacturing index, which in the past has had a stronger effect on the market. Industrial production, capacity utilization, etc. On Friday, there aren't any. Well, we have, excuse me, I take that back. The U.S. manufacturing PMI flash and the services flash comes out on Friday, the 16th. So we do have a pretty busy week, a very volatile week, I think, coming into the market. So let's take a look again at that big picture, where I have now added Fibonacci retracements. I've held off on doing this because of the nature of the ground that we're covering here. But now you can see that I've gone back and connected it to the bottom of wave 2, which was in 1932, I believe, and taking it all the way up to the high, which was in, let me get to it, I believe, in January of 2022. So those levels have now been added to the big picture. And what they are is for that super cycle wave 4. So for the super cycle wave 4, the first line is right at 3A2 is right at 2980. I'm calling it. So 3,029.80 fits right in there. Then we have a 50%, which by the way happens to be within primary fourth wave. So again, we're looking for the bottom of a cycle A wave. And so that, I believe, is going to coincide by the fourth wave of one lesser degree, the price territory of the primary 4, which actually is all the way up here at 33.89, all the way down to 2,200, we'll call it. Now, how am I going to fit this all in? We are already now in a primary C wave down. I've changed, I've reverted all of the labeling, right? But the alternate count remains in place for right now. But now I'm back to the count that is what, for me, my preferred count. And that is that we are in a primary C wave down. And within that, what it will be completing when we finish 5 waves of intermediate degree, to complete that primary C wave, it will also complete the cycle A wave. And once that A wave is in, expectations are, for me at least, for a very strong counter trend still, but a very strong counter trend rally and advance. And it should be strong, and it should be based on a combination of factors. Now, before we get to that point, we still have a pretty serious, at least two legs down, the third and the fifth, before we'll be ready to put in that big rally. What possibly is going to continue to pressure the market to quickly sell off? Well, we keep thinking that we're factored in interest rates properly. We have factored in inflation properly. We have factored in the recession, and I just don't think that that's true. And a lot of it is based on the fact that we're already talking about the Fed's going to ease, the Fed's going to pivot, the Fed's going to back off. And where we need to kind of fit that in is this also on a Fibonacci basis. We can see different levels. Now, what could propel it? It's like if it drops 0.382, that is major long-term support. So and even if you're running a chart that big, that's major support because of the size of what you're correcting, and then fitting that in to an Elliott count to what can we expect to be actually completing in those areas. So I'm looking for the completion of a cycle A wave. We're in the primary C wave decline. It's going to be 5 waves of intermediate degree. I do believe, you see, I've now put the 2, at least on the weekly chart here in the SPX. I'm putting that there, which suggests very highly that we are dropping in the beginning stages, as I discuss on the Elliott wave, updates, that we are starting an intermediate third wave down. What can that intermediate third wave do? Well, we can begin, drop down to the daily chart because it makes it a little bit easier to put this into gear. So we're going to be looking for the third wave. What do? We're going to put in some, Fibonacci extensions. And those extensions are going to cover wave 1 to wave 2, because the relationship that we're looking for is what is the relationship of the third wave to the first wave. Well, first thing is that we have to understand on the basis of Elliott, third waves, regardless of degree, but third waves are often the strongest and the longest out of waves 1, 3, and 5 within an impulse move. Impulse would be 5 waves. We're impulsing down, but it's still an impulse move. So what we have going on within that is the beginning stages, and they're going to be 5 waves of minor degree. So I believe that we're still almost getting into that stage where we'll be completing the minor wave 1. And when minor wave 1 is done, then we're going to go up in minor wave 2, come down in a third, which will produce some strength, get us into these areas. But ultimately, intermediate wave 3 can get us between 3266, but I believe we're going to be looking at 3,000 down to that 382 level, because we have several. So we have support coming in at 3266, but if it's a third wave and as strong as I believe it should be, it will exceed that. And then we're looking at 3,000, 70, 3,000, and just below where we have additional support from 2980 down to 2950. That zone is where I think that intermediate wave 3 can complete. We get an intermediate fourth wave, and then that intermediate fifth wave brings us into that next level, which on that very large count pulls in this 50% retracement level at 2,400, because now we can run fibs continuing 1.618, where this intermediate third wave would be 1.618 times the length of that first wave. That is the most common, and that comes in at 2751. Now, so we come in between these two, which is fine, but if it's serious enough and it's going to drive the market lower, if there is truly selling with purpose and there's something seriously happening, then we need to also consider that we have 2,400, and that's going to be that 50% level, and still only completing this intermediate third wave. If we get down into here, do a fourth and bring that fifth down, yes, Then I'm thinking that that would be clean, and we then would have at the 50% retracement level, cycle wave A setting the stage for that cycle wave B, which I would anticipate is going to run the market strongly higher. But if we're starting from down here, we've got plenty of room, and still 4,300 would not be out of that picture. Again, we would run Fibonacci retracements from the high to the low to come to the next rally phase. If we're finishing a cycle degree, I'm looking for a cycle degree rally back up, and then a cycle degree drop. So I want to make this clear. At some point out, so maybe exactly when, I cannot determine, because it depends on how quickly the market gets to these next levels. I have no idea that it would not take until mid 2023. First quarter, second quarter 2023, before this thing kind of meets the low for cycle wave A, and then we take off. So those are all the possibilities. But what we can do is week by week, we can track it. We can see the development. We can continue account. And that's going to continue to give us hints on timing, on shifts, on when something may start to rally. All right. Now, let me just go over to the NDX. We're just going to keep moving along here because we have a lot that I need to cover. The NASDAQ is also doing pretty much the exact same thing as the S&P. So the labeling and the count, they are identical. So we have the twin indexes primarily due to the fact that within the NASDAQ, the stocks that they share are Apple, Amazon, Google, Intel, Microsoft, Meta, Micron, NVIDIA. The big titans are shared in both. Tesla. They're in both of these indexes. And carry for example, Apple Computer carries the heaviest weighting in both the S&P and the NASDAQ. As you move down that list, then yes, the weightings may vary, because of course the S&P's 500 stocks, the NASDAQ's 100. But when you've got the bigger players carrying a heavier weight in both indexes, they tend to move the same. So what I'm looking at for the NASDAQ is the same. We're looking at a C wave, primary C wave decline. Within it, intermediate waves 1 and 2, I believe, are complete, including wave 2. Wave 1 for sure. Wave 2, I believe, is now complete. That would suggest we're in that beginning stages and still within the first minor wave down. So minor wave 1 of intermediate wave 2. Once it's complete, we're getting a minor wave 2 counter trend rally, and then we will drop in what I suspect will be a very strong down. Now, how is that going to fit in with what people are expecting with interest rates? They're not going to believe, because their mind is fixed on, we're being told by all of these people that supposedly are in the know that this is what we should expect. But we don't have any evidence other than what they're all talking about. Well, and then the statement that Jerome Powell made that, well, we could. And then I believe there's another governor who also was out, a Fed governor that was out talking that, yes, we could just pull back and only raise that rate a half a basis point versus 3/4 of a basis point. Whatever the situation may come in, the count itself is dictating that we're likely going to go down, and we're likely going to go down hard. Now, whether that actually begins, folks, because the alternate view for both the NASDAQ and the S&P remains in play, and I don't have confirmed confirmation, and I'm putting the wave 2 because I believe that the count itself is going to produce that. And that's why I'm looking for this additional 5th wave down. Now, the S&P is well on its way. The NASDAQ appears to be well on its way. And then we'll get the confirmation, and then we still have to get through CPI, and we have to get through the Fed meeting on Wednesday, plus the additional economic data that's due out this week. And what direction will that be pointing in? So a lot of the narrative may change. The wave count itself says it's not going to be well received. So that's the thought. Now, here again, we have, For the NASDAQ, I only went to the low of cycle wave 2. And I felt that what we're really correcting is that particular wave. Only because I don't have the data that goes back. So these are kind of preliminary, and they're also have to be adjustable. If I can find a different chart, because I know the NASDAQ was around before 1986, and that would be the composite, that would be able to go back and look at additional data as to make a determination, where did that cycle wave 1 begin? Because I would want to do that so that we get that whole cycle degree rally, that's what's being corrected now. So if I've been truly correcting, if these are going to be moved up to, I have to leave them at cycle. So in any case, I need a little bit more data, but I wanted to put in some picture that we could have, and that would be from the low of wave 2 to the high of wave 5. So again, kind of a strange little idea, but to still believe that that could be giving me workable Fibonacci levels. So I've added them so that as we're coming in, I can put a little bit more perspective on where I believe this cycle wave A can come in. So go back down to that weekly chart, and we're in primary A's done, primary B's done. We're in the primary C wave. Wave 1 and 2, I believe, are in. Where can this third wave come in? Well, we've got these levels, which actually I don't like right now, and I am going to take them off because they're beginning to interfere, because I do believe wave 3 here is going to bring us down into this area, 88.35. I will go out and get the correct numbers. I apologize for putting those up because I see the error of my ways in determining it from the bottom of wave 2 to the top of cycle wave 5. It needs to be broader than that, so I need to go find the data. In the meantime, I'm still looking for this third wave. We have 88.35, which is where wave 3 would be 100% of wave 1. I believe it needs to come in bigger because, again, as we just discussed for the S&P, same conditions exist here in the NASDAQ. And that is that wave 3 should be the longest and the strongest, in which case it should definitely be longer and stronger than wave 1, which was pretty strong. So I'm looking for these levels down here. Now, again, ultimately, I'm looking for cycle wave A to come in here inside this particular primary fourth wave, which was March of 2020. And that's at 60, I think it was 67.71. So within that area. But if wave 3 brings us down into here, we get a 4, and wave 5 brings us at 68.07, we're there. We're in 1.618 for that entire C wave. Now, where can I also, should put these also on the S&P. I can put the same thing in, and now we're just going to look at primary C wave levels. Primary C wave levels, see, they swirl around right there. But they also, severe enough, they can drop us down into that next zone. We have several zones coming in to these numbers for the wave count. So cycle wave A, and I need to put the super cycle wave 3 back up there. Cycle wave A will come in likely down in this zone right here. Then we're going to get a cycle B, and then we get a cycle C wave bringing it all back down, and that can bring us down into here, because what we're really going to be looking at, what we truly will be looking at, is the 2009 low and the 2002 low. Those are the lows where we can find the support for this much larger degree. Now, consider that what we're correcting here, folks, is the massive amounts of money that were injected into the system here and here. So, if anything, we're correcting this fifth wave. And that in and of itself, I will put up retracements, and we'll see what they look like. If I believe what we're just considering is just going to be correcting, boom, more. I'm going to bring it in. We're looking at 382 is already, we're there, 0.50. we haven't reached yet. 618 is back down at that level of this fourth wave. So again, however I put it together, we get the same zones. And that's my point. That's what I want to be showing here, that wherever we are looking and where we're putting our fibs in, we tend to get into that same zone area, right? There's the broader, that larger drop. And here we have all the ones, and they're matching up at the 89, 8,800 level. They're matching up at 8,000 down to 75.82. They're matching up at 69 down to 65. So they're there. So we can get the C, get the B wave, and then get a cycle A, cycle B wave, and a cycle C wave down. For whatever reason, we will be revisiting all of this. After the rally, we'll revisit. And even if we want to consider the whole thing combined as just an extended market decline, crash, whatever you want to call it, it may contain the crash, but it's going to come out. It's whatever happens within that's going to create this larger C wave decline, a cycle C wave decline. It's going to be something shocking to the markets, to our world, basically. So again, not knowing, we have to consider. That's it for those. Now, I want to go over to the 30-year bond. That's where I'm going to start for right now. The 30-year bond is also putting in a decent rally, and it has come back. Excuse me, I had to stand up and turn on a light. Boy, it sounded like I walked away because I did. And it's been a solid rally. But it's corrective. Now, on the weekly chart, I just marked where we have this high represents basically where the rate was 1.17% or thereabouts. So this was kind of a fluke. And if I go to where the wave really ended, it's here. So from there, we do 5 waves down. And I'm going to consider even that to be like an A wave. And now we're putting in the B wave. So we have not yet reached 0.236 of that decline. And therefore, I would suggest that we're likely finishing only an A wave of what will ultimately be an ABC. So this is going to take more time. And I'm not on a weekly chart. If I bring it down to a daily chart, I get an AB, and likely what is a 1, 2, and then a 3, probably here, and this is a 4, so maybe we get a 5 before we complete an ABC up. Now, whether that then turns into the entire correction, because we reach a Fibonacci level, that is something else yet to be seen. But if I'm doing it purely on the weekly looks like it needs at least, it could also be 5 waves up and still need 1 more and an A wave. So whether I count that A wave as a 5 wave or a 3 wave isn't as important as measuring just what's going on inside. So we saw that the market on Friday got itself up back above 131, but finished down pretty strongly on the day. Now, is that just the 4? And then we're going to go up one more time, and we have a trend line that's coming in, and then from here or there, we're getting down to 132. Maybe we do a quick rally up to 132, and that could come on Wednesday. You know, they get it right up there, but we're still hugging and hanging around 3.5. Now, remember, that was the number that's kind of been tossed around. 3.5% yield, 3.5% yield, 3.5% yield. And primarily, I've been attaching it to the 10-year note. And we know that that's a number where the positions are changing, where things are being exchanged, and uncertain right now where we're going to reinstitute risk at that 3.5 level, or are we now going to wait because there's a possibility that we can put that risk back on just a little bit higher? Who knows? I don't. So this rotation into bonds right now may continue, even if we get a B wave, and then we still get a C wave. So if we get an A and a B and a C, the levels coming up are 135 and then 145, and almost 146 actually. And that's just 382. of that larger drop. It was a 5-week, excuse me, it was a 5-wave decline, accountable on the weekly chart. Now, so we have to allow for up, but if it's done, we already know that interest rates are going to have to continue to go up. The Fed, and by no means has let on in any way, shape, or form, that we're just going to start pivoting and we're going to start not raising as high. In fact, we're going to probably maybe even skip a month here and there. I know there's a couple of well-respected analysts from the larger bank firms, but I still think that rates are going to have to go up. And I think that as we move forward, we'll get more evidence from the continued economic data that'll be presented. So I would suspect 5 waves down, and I'm going to pull this out to the monthly chart. 5 waves down in and of itself is never a complete move. So I'm counting this up. I'm counting this under an Elliott manner. 5 waves down would suggest we get 3 waves up, and then we get another 5 waves down. That suggests that we get a little relaxation maybe in the rate. I think we still got another leg down, and then we can put in either another smaller bounce with yet an additional 5, if it's going to be 5 waves down total on a larger scale. Or are we going to go down in ABC, up in ABC, and then come back down again in a 5 waves, which would just make a larger corrective pattern off of this high, off of this bond price high. So yes, we can do that. And that would just cover all the periods of time that the stock market or the equity markets and other markets are likely going to see larger moves. If we're expecting larger moves in equities, first to the downside, then to the upside, and then again to the downside, does that not also fit with interest rates and the movement in interest rates? So to balance that out, I look at the Elliott and say, yes, it is possible. It's not a very large ABC. It has potential, but I would think that we're going to go down first, and then we could rally again. So maybe this correction in and of itself gets a little bit higher, puts in an A wave, slides lower in a B, and it can come all the way back down here. Or if it wants to be an irregular, it can go a little bit further. Or I'm miscounting, and this is really 1, 2, 3, and this is a 4, and we have that 5th coming now, and then we get the relief. So we've got a couple of situations. More than likely, this level, which I believe is probably close to 4%, I'm not sure, will be taken out. Whether that happens now or whether that happens next year, I believe it will be taken out, which means rates will be much higher than they are now. But we're in a corrective phase across the board. 10-year Treasury, same deal. I can count 5 down. So I'm looking at 3 waves up. But we get, this is the monthly. So right now, on the 9th, the rate was 3.44. I think I said 449. That's wrong. It's actually 489. And let me edit that. Go there. That's the correct number. So basically 3.5. So on the first, it was 3.53. They brought it even a little bit more because you can see we rallied. But again, like the others, like the 10-year, like the 30-year, on Friday, the market decided to turn and go lower. So like the 10-year note reached its high on the 7th out of this particular sequence. And again, same deal. A, B, 1, 2, and then 1, 2, 3, 4, 5, 1 of 3. Or A, B, 1 of C, 2 of C, 3 of C, 4 of C, 5 of C. So I got a couple of things going on here, but we do have still that potential. And I would anticipate that we're likely to get there unless we start breaking below the 20 on the daily, which right now is sitting at 113, 113, 115. I know we got to consider all of that. And then we have the 50 right below. and then we have another 50. So, but I think that it's either ABC, and then we're going to get an ABC down, and then we're still going to get a C wave. All possible. So what we've witnessed thus far is not too much change, but again, moving and swirling around 3.5. So I think what happens is we have a lot of position traders. We have a lot of funds, hedge funds and alike, that put on trades and are now deciding for the next beginning of the year, how do they need to position themselves? What are we looking at? And so is it going to be risk on at 3.5, or is it going to be risk on at 2 3/4? I don't know. But if it starts to really drop, we may see that risk on position start to come back in at a little bit different rate. So, and I don't know if they really want to be squeezed, but if it starts to get going, we may see it jump into action. And again, then we're going to have to decide, is it just an ABC and then a B wave, and then we still got a C wave up, and then a larger drop? So again, balancing that out with what's going on is not that easy. But the wave patterns themselves are pretty steady in terms of what I'm seeing against what should occur. So again, in the 10-year note, 236 has not been reached yet, and that's at 116. 121 is 382. That's the more normal levels. But again, in bonds, if I go further out where I can see, you know, they had a lot of play with a constant little upside, and then that was the final. But if I'm looking at what I'm going through, we've got this very big decline, which is not showing up anywhere, something like that. So because I can only go back to 2004, when I go back further and look at the longer term charts, the 30-year chart, I mean, it was like 5 up. So we're just going to be doing an ABC, and it's going to take a while before it's done. We have all of 23 and into 24. Now, down to the 5-year note. The 5-year note, they're all exactly the same, but so we're really just kind of updating the status of where we are now. So again, 5 waves down, we're looking for 3 up. The 5-year is hugging, instead of 3.5, it's 3.75. And then I want it down to the 2-year. So the very short end of the curve is not willing to move too far beyond where their current levels are before they believe, I think they realize that we're going to go, that yields will go back up, not down. If the yields, either that or that's an A and it's going to be a B, and then we're going to do a C, and then we will see it get to 3.5 or beyond. Because again, 5 down, there's our resistance for a bounce. 110, 113. And 113, 127, 110, 115. So again, same deal. And we got, as of Friday, we were sitting at 3.75%. Then we have, last but not least, the 2-year note, and same deal. 2-year note still above 4%. But then again, as we drop down and start looking at T-bills are all above 4%. And they continue to go up every auction. So as we look out at Treasuries, that's a good auction. And so the movement out of stocks into bonds may be happening down here. And so we're going to see these rates start to get, if we do, in a continued rise, we'll see these rates getting locked in, and they'll be going fast. Because if people are moving out of equities, they want to get a return while they wait for the correction in equities to settle out. 4.33, 2 years, all fits. So now, let me go over. One thing I want to start going into is gold. Gold is perking back up. I just want to review. This is the monthly on gold. And gold is one of my more favorite markets, has been for years and years. But I rarely include it because most people don't prefer to trade it. But I think gold is a long-term hold. And it is protection against so many different things that can happen economically and that can happen to a fiat currency. So, boom. The larger picture is that we are in a cycle degree, fifth wave up. Now, and again, and I think I may have explained this, I do it the same in bonds and I do the same for gold, precious metals, and commodities. The highest degree that I'll count is cycle. So what the cycle degree is telling us on this upswing is that this was wave one of a primary degree, wave two of a primary degree. It was a beautiful correction, totally beautiful correction. And now we're into that third primary wave three. Now, understand that it normally is the fifth wave. It's the fifth wave in a commodity and a precious metal where we see that blow off, that run for the gold. And it was in 503 when we ran, and then we dropping. And now, and by my count, I feel that we finished an ABC down for a minor wave 4. We're in minor wave 5 to complete the intermediate third wave. Where does that come in? The fibs tell me that for a minor fifth or for any fifth wave, we relate it to the third. And so I'm related on the intermediate 3. I'm going to go relate it here to this third so I can see where's this all going to come in. If I can take it and put one tighter one on there for you. And let me just change this, and that's going to tighten it up. This low. There's one other way because I'm looking for a minor fifth wave, and we want to see where that's going to go. And so this is 11. Let me see what it was. 1167.10. Give me one quick second, and I'm going to go in there and change that. Edit the properties, and we're there, and that was 1124. And this is one more time. My poor memory doesn't always last me. 1167 is what I said. Endpoint. $67. I'm going to take that off and say okay. And it makes an adjustment, yes. So 618 is 2188, definitely new highs. Again, intermediate third wave should be strong, which it has been. And the minor third wave should be strong, which it was. Minor 5 still can be the one that reaches up to new heights. 618 is most common, but we're in a minor fifth wave. So if we start to really cook, we have 2188, so 89, 2268, 2343, 2540, and upward. So if wave 5 comes up 1.618, we're looking at 31. Are these possible? Yes. Is there situations that could drive it? Yes. There are several that could really enforce that gold will start backing things. And here's the biggest one that I'm going to tell you about. And I started to talk about this last week, that China, Russia, India, the United States, Japan, the European Union are all digitalizing their currencies. No one will be left behind here. So there's a lot of change brewing. And what we're seeing is there are selective countries, in fact, most of them, are coming back into the gold market because what they need to do with that digitalized currency is back it by gold. A fiat currency produces the scams that we just went through with Bitcoin. If it's backed by gold, it could be a whole different valuation. So you want to support your currency on international trade, back it by gold, back it with something that's tangible. I'm thinking that this is the route that's going to happen here, folks. So if that does happen, this fifth wave is going to go through the roof. Add to it the massive shorts in gold, the massive shorts in silver, etc. A lot of stuff can happen and really create a situation where it's explosive, very, very explosive. It's still going to trade. We're still within we're still in primary 3, so we haven't even gotten that out of the way, plus primary 4, and then a primary 5, which within the cycle 5, boom, and that's yet to come. So if you are a long-term trader in gold, there are several ways where you can participate without having to spend a large amount of money. If you've got it and you can put some, designate some to precious metals or gold and silver, there are many different ways in which to purchase. So if you have any questions about that, either you can leave a comment and I'll mention something. But I do not make recommendations, but I can tell you what I feel is a good place to put money if you're not already in physical gold, because physical gold does then encompass doing a lot more with it. You just can't have a troy ounce of gold and sitting in your house. So you got to store it. You got to put it somewhere. Anyway, primary wave 3 has a lot of potential. Silver, same basic thoughts. Here we are on the monthly chart in silver. Same deal. Primary 1, primary 2. We're into the intermediate third wave. That's on my max monthly. Now, the entire, right? We've gone back to the lows in 1993. And we're running this up to that high that we had at 49, what was it? 49.82 in April of 2011. It was beautiful. And we had this crushing decline, right? Back down to 1164. And now we're beginning the rally again in a primary third, of which we've finished intermediate waves 1 and 2. We're in the intermediate third wave. I would be expecting it to take out that high. So I think the third wave can carry us at least up to 49, up to 58. Then we back off, and then we still have more to come before intermediate wave 3 and primary wave 3 are complete. So silver has a lot of upside potential. It tends to be, lack of a better word, the bastard stepchild to gold, and it gets knocked down much quicker. And they really will crush it because they think it has no value. And actually it does. And if we go really deep into recession and we end up that a lot of places are getting hit a lot harder, you're going to see these precious metals go up. You're going to see these precious metals be accumulated. They will be means to which people can transact business or back a particular loan, a particular whatever. So there will be many other uses for silver other than jewelry and certain, different products. All right. One last thing, and we're going to call it a day on this because I'm sure it's already long enough. And that's going to be the dollar index. So again, when we start up at the top of the pecking order, we have interest rates, and we have bonds. We have the currency, in our case, the US dollar. Others, it's going to be their currency. And then we have corporate, and then we have retail, et cetera, how it flows down. So the dollar index is, of course, extremely interest rate sensitive. If the United States decides that they're going to pay 6, 8, 10% over a specific period of time for my dollars, they're going to receive a lot more dollars than if they're only willing to give you 0.17% for you giving them your dollars. So as the dollar goes up, it becomes more valuable to capture these higher interest rates. So they're going to want dollars. So right now, the dollar is correcting. Here's the long-term view. And I don't know if it's A or 1, 2, 3, 4, 5 of what. That's why I put it in a color that I've not used before, because it's just a 5 waves. This is just an ABC, which I'm putting an A. I got the B, and I'm looking for a C wave. That's just kind of where I'm feeling the dollar is doing. And if anything, I would come down below all of this, and I put an A wave down here. And then counting a B wave, which suggests that the dollar can get back towards 121 or 120. Now, if this is a C wave, this in my mind is a 4th wave. And deep as it is, I believe we've reached levels that are, I had support at the 104 area, down a little bit below at the 103 handle somewhere, and a couple of levels in there before this market turns and starts to go up. What will drive it is any surprises to the on the CPI, on jobless claims, or any of those nature. But currently they continue to sell the dollar for other reasons that of course are real, but in terms of what the market is expecting. If the market is expecting a pivot, then the dollar, they're not going to be paying as high of a rate. That's why you see this big flurry into bonds. Well, better get in now, because this is the rate. I'm going to get 3.5 because the dollar's certainly going to start sinking. I'm not going to get it there. So go lock it in. In any case, I think the dollar should find its low rather quickly here. And if we already have done that, then we should start to see it rally again. And I'm looking for it to complete a C wave. So again, this is a pretty nasty little ride down from 114 down to 104. So, you know, it lost a nice little chunk, but I don't think beyond reality. So if I'm looking at it, I would have to have been 1, 2. This is just a 4. And I'm going to add that drawing, add that fib. 382. 382. So it still has more. It could go. 382 was 105. Dropping down to 104 is still within the realm because we got the 50s right there. We have on the weekly chart, we have the 50 period SMA at 103.75, 73. So it still has a little bit more, but these are not unusual, sorry, too big wave 4 levels. And they fit. So what can the next rally up bring us? Well, I would think that we start to get up, and now we're back out into here on a rally again. Coming up, 118, 121. But I don't think we should go above 121 right now on the basis that I'm believing that it's an ABC. Oh, one more chart. And it'll be a flat. So we'll equal 2001 highs. And then, so anywhere even below 118, perfect. But I believe we will take out 114, 115 and then go up. And then if this is an A wave and this is a B wave, I'm looking for a pretty much crushing C wave, which I'm looking for a counter trend cycle wave B in the equity markets. They're not going to do it if interest rates are not going to, or if the dollar doesn't come flying back down, if interest rates don't start dropping a little bit, that all these things will work in conjunction with one another. So we can be looking, if we're looking for the market to rally, and we're looking for the bond market to ease up on those rates. So yields drop, bond prices go up. The dollar drops because its appeal is a little bit different. It will still be in demand for do different things, and we'll see little flurries here and there, but the trend will likely be down because we're not buying it to get interest. Okay, that's the whole picture. It's a bigger picture. I want to thank you all for hanging out with me and for listening. Again, any questions, please feel free to put them in the comment section. And if you need, you want to email me, ask in the comment section. I will provide that email address for you. And then we'll go from there. Again, thank you for listening today. Have a great trading week. Be prepared for the unexpected. And the next Eye of the Storm podcast will be on Sunday, the 18th.